Hi, everyone. Good morning and welcome. Thank you so much for joining us today. It's dreary in Texas, but I hope it's lovely out wherever you are. We have Mike Knotts with Higginbotham in today, and he's just back in from Cayman. So, we're glad to have him here ahead of the hurricane, and of course, Mr. Mark Ray in the Dallas area. We have a lot to cover today, and it's a really timely and exciting topic because we all know the cost of insurance is just wild out there, and everyone we talk to is asking, what can we do? How can we control these costs? And, where can we move the needle even just a little bit? So we're very excited to hear about this. Before we jump in, I do want to first invite everyone to jump into the chat. Let us know where you are coming from. If you are in a captive already, if you're not, then who is your insurance provider and are you liking it? And tell us what you have going on over there. We'd love to see you in chat. For next coming up, before we again jump in, I do just want to also remind everybody that we have several other events coming up in the next few months. We have a webinar tomorrow with Brandon Weissman on FMCSA's proposed pilot changes to hours of service. So that's going to be a good one to jump in on. And, Brandon is full of good information, very good with the regulations. So tune in for that. A couple of other webinars and boot camps. We do boot camp twice a month. We still have a little bit of room left in the November boot camp. I think maybe 2 or 3 more spots and then a few spots left in December. So come join us in Dallas live. Mark Ray and our own Steve Kessler host a 2-day program on risk mitigation, safety best practices, all of the things you can do proactively and do to prevent accidents, injuries, and claims, which is just so key again to this topic. And then at the end of November, we're also hosting a webinar with ATRI. Rebecca Brewster is coming to talk about the top issues report, which was just released over the weekend at MCNE. So that one's really timely again for this conversation because the top 3 issues I think we all expected. Number 1 was economy. Number 2, nuclear verdicts or lawsuit abuse. And number 3, the rising cost of insurance. So very timely. Mike, we are so delighted to have you today. And I think with that, we'll just pass it right along because we want to hear the good stuff.
All right. Well, welcome everybody, and hope to make contact eventually at some point in time. If anyone has any questions, please feel free to jump in anytime. Hopefully we'll have some time at the end. So just briefly, I'm in the great state of Louisiana today, as Lydia said, and if anyone knows anything about the great state of Louisiana, the only thing that we're the top leader in is our cost of insurance in a negative way. So I started in the trucking business 42 years ago, selling standard market trucking insurance, the Carolina casualties, the canals, the NICOs, the trucking marketplace. And in doing that, I kept passing along the cost to my insureds, and I kept telling them to hire better drivers, do safety plans, use all the safety tools we have, pay attention to claims, and by doing that, we're going to lower their insurance costs. Well, that never happened. The cost of insurance just kept going up and up and up. And so finally, I'm going to say the mid-90s, my clients came to me and said, Mike, if you don't find a solution, we're out of business. And if we're out of business, you're out of business. And of course, they didn't have to tell me that. That was very obvious. And so by doing that, I started exploring. And my first option was to go look for new insurance companies. And everywhere I turned, the insurance companies told me they weren't coming to the great state of Louisiana. And they loved our food, but they didn't love our trucking or our claims attorneys, our plaintiff attorneys. And so with that, I had to find another alternative. So not trying to impress anyone with my knowledge today of the insurance business, but I am saying I'm a survivalist. And so we turned to group captives. And in group captives, I'm going to tell you briefly today, very quickly about group captives, and again, open for questions at the end. But basically, the group captives are looking for the top 20% of the marketplace. So everyone's not going to be a group captive candidate, and we're happy to help. Our agent is happy to help vet you and tell you if you're a group captive candidate. Actually, your losses dictate most of that, and so we can tell you from your losses pretty quick if you're an option. And then most group captives require a minimum of $250,000 in premium. It's auto liability, general liability, and workers' comp. And so those three lines, primarily your auto physical damage, can also go in there to make up to 250. And so if you pay that, but if you're much of a trucking company, you pay that pretty quick. So regardless of what state you're in. So I would say from a premium standpoint, most trucking clients are a prospect. It's strictly then be your losses, and then we get into your safety. Your CAB score for trucking clients plays in really, again, the captives, because you're going in business. And Lydia, if you scroll across a page or two here now, let's go
Oh,
ahead.
sure.
All right. So this is the traditional way. One more. Let's go back.
Oh, go back right here. Okay.
It's the traditional way we buy insurance. You buy it from an insurance carrier, you put it into the premium into their policy. They take out their operating costs and any losses, and then the insurance company gets to keep the profits if there is any profits left at the end. Okay. And so we're going to talk about the next option, which is group captives on the next page. And basically you can think of it like a co-op. Lydia, one page. Yeah, think of it like a co-op, but here's the difference, and here's the definition. It's an insurance company that is owned and controlled by its members for the benefit of its members. Now, if you'll notice in that definition, nowhere does it say insurance company. Okay, so company A, company B, company C, and company D all own a share. That share is typically $36,000, and everyone owns a share of the stock, and everybody has one vote, regardless of your trucking company size or premium. Okay. So it is, and that's really key. And for you guys that may be in a captive, you want to make sure your agent reminds the vendors, be it the captive manager or the claims person or the loss control team, that of this definition. So I keep this definition very close. I can recite it, and the vendors don't always like to hear it, but the members in a member-owned captive, okay? Now you have some captives that are sponsored by insurance companies, and I won't mention any of those today, but they're sponsored by an insurance company. Well, the insurance company owns that captive. Or you have some that are sponsored by an agency, and I won't mention those agencies. Well, the insurance agency owns this captive. So I'm a believer in member-owned captives. So that means you, the members, the trucking companies, actually own the captives. You have 2 board meetings a year. You get to vote. The insurance companies can't vote. The vendors can't vote. The agents can't vote. So you, the members, get to vote. And so you also own the equity. And we'll talk about that in just a second. Next page, Lydia, please. So, it's going to provide you ownership, as we just talked about, more control, improves claims handling, risk management. We're going to provide you some premium development transparency. We'll show you that in just a second. And then return at the end some underwriting profits and some investment income. And I'll show you examples of those as well. Next page, please. So I'm a B and C student from the great state of Louisiana again. So our education system is also down there with our insurance. But I'm very much a picture guy in that age group. And so I had to do something visual here for me. So in this particular case, the building is the captive. So we're all A, B, C, D, all companies are in the building, and the actual condo units themselves are the different members in the building. So the building takes the first, in this example, the first $300,000, not each individual member. And then we buy reinsurance from an A-rated company above that to up to $2 million in this particular example. And this is most captives today. You're going to receive a policy from an A-rated carrier, A+ rated carrier, and you're going to receive reinsurance for them. So if you get a certificate of insurance, let's say this captive was named Trip, okay? Well, you're not going to see Trip anywhere on your policy and or your certificate. You're going to see the name of the insurance company. It can be, and I'll just use one example, AIG. You're going to Zurich. You're going to see the name of that insurance company on your certificate and on your policy. So unless you tell someone that you're in a captive, they'll never know you're in a captive. Next page, buddy. All right, so here's a real simple example of how the premium flows. So I like to say on the fixed cost, that's typically 45%, maybe 50 on the high side. And that's going to take care of your reinsurance, your policy issuance, your claims administration, your loss control, and any other expenses to run the captive. Then the other 55 to 50% is going to be in two loss funds. And different captives refer to this as a frequency fund or an A fund, 0 to 100. And that number just was in a captive meeting last week because of the cost of trucks now. That number can fluctuate up to 125 or 150. And then the second bucket is severity fund or your B fund. And that in this example is 100 to 300. So this is the cost of the claim. So a claim less than 100,000 comes out of your A fund, your frequency fund. Once it goes to 101,000, it comes out of your B fund. And each person, and I'll show you this example in a minute, will be assigned the premium for their particular losses to those buckets. And so we'll go from there. If you don't spend those dollars, and I could stop right here for a lot of people. If you don't spend those dollars, those are your member dividends. Those come back to you. And so we'll talk about that in just a little bit as well. Okay.
Mike, when you say claim,
Yes.
is that the estimate? Is that the reserve that you set up for a claim?
It's paid and reserved. So let's say we've got a truck accident, and we all know that a Peterbilt doesn't cost $150,000 anymore. Peterbilt's $200,000 or better, and so new one. And so let's say we wrecked a Peterbilt. Well, we're going to get the first 100 out of the A fund, and then the rest of the claim is going to go into the B fund. And I'll have some examples of that in just a second. But it's on each individual claim.
Okay.
Yes, sir.
Mm.
Okay.
Okay.
All right. So, and again, I'm a picture guy, so we'll make sure we got this. So we're trying to predict what you need in your A fund. Okay. And that's what we're trying to predict. That's what actuarially, not Mike, not the insurance company, actuarially, we're trying to predict that. And so if Mark and I went out and shot basketball today and we shot from half court, not very predictable how many we're going to make. Okay. If we got to the 3-point line, Mark may make a few. I'm not a very good basketball player, so probably not going to make many. So it's not very predictable. But if we get to the free throw line, Mark and I could shoot underhanded if we wanted to. And if we shoot enough, enough there, we're going to eventually say Mark's going to make 4, I'm going to make 3, but we've got the predictable layer. So in insurance, casualty insurance, the predictable layer is the A fund. That's 100,000 and below. So on the next page, I'm going to show you by getting your historical losses, your historical premiums, and your historical exposures. One more, Lydia, please. My son, they're right here. I'm going to show you by this. This is what an actuarial loss pick looks like. I'm not expecting you to understand the numbers, follow the numbers. The numbers are really irrelevant. It's the formula here that I want you to pay attention to, and I'll lead you through. So in column, let's see, the top box up there, that's CAL on the far left. That's commercial auto liability. So in this particular client's example, commercial auto liability, you'll see commercial auto physical damage and work comp. Each one of them have their own boxes and their own calculation. So in column 4, I've got the client's prior premiums. So for all you guys, out there that say, well, I'm not giving my agent or my prospective agent my premiums because he's just going to come in below that. Well, take it from an agent himself. I wish it were that easy, and I wish I could talk somebody into doing that. That's not the way it works, okay? But in the captive scenario, I'm going to show you why this is very, very important for you. So I've got your prior premiums, starting with your oldest year coming down. I'm sorry, your newest year in this example. This is an old example, but in your newest year coming down to your oldest year, okay? Column 5 is industry expected loss ratios. That's really for the actuary. It won't have any bearing here. Column 6A and 6B are the total losses. Okay. So if you'll notice, I'm taking out all losses in excess of 100. Okay. Because I'm trying to predict losses in that A fund bucket, which is 100 and below. You follow me there, Mark? Okay. So all I'm focused on is the losses 100 and below. And so column 8, okay, is called the loss development method. Okay, so that's where I've taken your loss of $8,000 in the top there, and I've gone across and using actuarial loss developments, because we know as a claim gets older, it's going to cost more. That's that reserving that you refer to, unless it's a physical damage or, a property loss, it's going to cost more. And so they developed that $8,000 out to $14,000. Well, let's say you got a lot of zeros like you do in year 2020, 2021, or 1920, or 1819. You got zeros in there. Well, zeros are Mark and I not shooting enough shots. Well, if Mark and I don't shoot enough shots, how are we going to predict what our losses are going to be? So what they then take is, this is where your premiums are important. They take your premiums for those years, okay, times the expected loss ratio and the expected utilization loss ratio, and they come up with a number. And so if you'll notice in column 10, okay, it is either a blend, okay, the selected ultimate is either a blend or what the actuary believed was more actuarially predictable. And so, but if you noticed in those bottom 3 years, we had to use the premium and the BF method, which is based off your premiums, because there wasn't enough shots taken. Okay. Well, we do that for every section. If you'll notice, column 12 is your exposures. This particular client's got 26 trucks in his most current year, 25 in the year past, and he had 117 total for the 5-year total. Loss cost is, we take your number of trucks each year divided by your selected ultimate. And so that's how we come up with a loss cost, which is the amount per truck that we need in your A fund. Well, again, we all know that trend is a real thing. Okay, that's the cost of claims getting older, and so we have to add some trend, and we come up in column 15 with your trended loss costs. Okay, and that $2,000 is how much, $2,062 for that year is what they're suggesting that we need. Well, we take a 5-year average down at the bottom, the 902, Lydia, right down there. If you'll take your mouse and come down, straight down, Lydia, right there, the 902. Well, this is the end of the math for this whole presentation, and I apologize if I bored you, but I wanted y'all to understand each year you're going to take out the oldest year, we're going to put in the newest year, and each year this is how your rates are going to be established. Now, I'm going to use Mark, Lydia, and I as an example. If we were all in this captive together and this is Mark's numbers, this is not going to affect Lydia or I. It's only going to affect Mark. So I'm going to say this here and you'll hear me say it again. I think this is the fairest way to buy your insurance because it depends on me and I have some control of my destiny. It's not everybody else that's insured with XYZ insurance company, or everybody else that's insured in the same city I'm in, or the trucker down the road. Every situation is unique, and it's unique to those members because this is this member's numbers. 2 other things I point out on this page. Where do you see anything regarding trucking? And where do you see anything that says anything about a particular state? This is strictly math. Okay, so I think this is the fairest way. Now, Lydia, the next page is what I call the Holy Grail.
Okay, here we go.
Okay, so I'm going to take that 902 that we just developed
Mhm.
right on the page before times the current number of trucks at 28. Well, guess what? There's my eighth run premium right there. Okay, in column 4. Okay, there it is. And in column 5, I'm taking 50% of my A fund, and there's my B fund. Remember, so my A fund, B fund. So now I just got my A fund, B fund from the math, from Mark's math, the page before. I now have Mark's A fund, B fund. Not mine, not Lydia's, not anybody else's. I have Mark's A fund, B fund calculation, and you see the total there. Well, guess what? Your fixed cost, and that's the page, 2 pages back, Lydia, that we'll go to here in just a second. But your fixed cost is a mathematical function of your A plus your B. So this is math. It's based on your math. And you're going to hear me say one more thing, Mark, before your question. I see it coming. One more thing is, so I tell my group, and I'll tell you how we're staffed a little different than most, and a question that y'all need to ask your agent. This is really important, because I tell them I'm not selling insurance anymore, because your math figures out your cost. Okay. We're not shopping because you own this company. Okay. So we're not shopping. So I have 2 jobs, and I have 10 claims people, and I have 7 loss control people. And so my 2 jobs are to help you either prevent a loss through safety, or to either mitigate a loss through my claims team. Okay. And if I do that, I'm going to affect your math on the page before. And if I affect your math, help you affect your math, you've just affected your cost. Not the guy down the street, not the next trucker in the next county over or whatever. You've just affected your cost. So in my mind, this is the fairest way to buy insurance. And Mark, with that, I'm going to stop, take a few questions if that's okay.
Yeah, I had just one quick question
Sure.
on the expected loss ratio calculation. Who determines that?
Okay, go back over a page, Lydia, if you will.
Yeah, go back. I think it's number 5 there.
Right. So that is
Expected.
that's an industry expected, and the actuary comes up with that, and that's just an industry expected. It's, you can find those from many different sources, and they very rarely vary. If they do, they vary a 0.1 or 0.2, but that's a industry expected. And the longer you're in the captive, Mark, I'll say this, that's an industry expected that we've used there. But the longer you're in the captive, you start using the captive expected loss ratio, which is better than the industry. Okay, so that's the advantage of being in the captive for a longer period of time. Now, I need to tell you right here, so, and I want to say this, so I'll give you, I won't mention their names, but I'll give you 2 of my saltwater haulers in North Louisiana. And one has 104 trucks, the other one has about 70 trucks. I have one that has had extremely good luck. I'll say it's because luck plays into this as much as safety or anything else. Okay, but he's had extremely good luck, and he does a good job with safety and hiring drivers. His cost for $2 million worth of auto liability insurance is $1,100 a truck. He actually pays more for physical damage because of some wrecks that he's had that just were physical damage wrecks. Okay, which again goes in his physical damage column, doesn't go in his auto liability column. But his auto liability for $2 million is $1,100 a truck. I pay more for car insurance. Okay, so that's that. But I have another client that is less than 20 miles from him, same captive, in the trucking business, does the exact same thing, runs on the same roads, does a lot of things. His cost is $8,800 a truck. That's my example of, everybody's numbers determine their cost and not the other guy's cost. Okay. So I just want to make sure that I make that. And this is something that is happening. If you buy traditional insurance today, you just don't see it. Okay. You get to see this, and your agent and the captives will and should share this with you. Okay. Because I will tell you, we give them all this data. Your agent will give them all this data. And we find that, when they give it back to us, and they give it to us, this is the other thing that's really important. They give it back to us about 75 days in advance of your renewal. And so at that point in time, I pretty much know what your renewal is going to be. There's a little bit more to it, but I pretty much know what your renewal is going to be. 45 days out, I know what your renewal is going to be. Okay. But what reason we get it at 75 and it takes to 45 is they put an APD loss up in the AL section. They fat fingered some numbers. It's just human error. And so we go back and check each one of these to make sure the numbers, the losses were put in correctly. The exposures are correctly, because all these numbers play off of each other. So anyway, I know I don't want to harp on that. But Lydia, if we have some questions, I'm happy to answer some of those now. If we don't, I'll keep going.
I'm not seeing anything in chat right now. So
Okay.
I think we can just keep moving on, although we have a lot of people in, let's see, Tennessee, Carolina, Texas. So
Yeah. Well, let's keep moving then. We'll move
my
on.
internet's a little
Just,
unstable here, guys.
just an observation, Mike. I
Yep.
know, sharing risk can be a risky business.
Yep.
And I hadn't seen anything in these calculations that if I'm in a captive with
Yep.
Lydia,
Yep.
that would impact her
I'm
bad
fixing-
rate
You-
from my rate. So if you're sharing risks, I don't see how your partners come into play here.
You jumped just a little bit ahead of me, and we're
Oh,
gonna get
okay.
Yeah,
That's
we'll get
next.
there. Yeah,
That's the next
okay.
spreadsheet.
Yes, sir. Keep going, Lydia. Let's go one. All right, here's an example. So let's just go right here. This is a typical example. I'm going to give you 3 years, and one of those is that sharing year mark, so you'll understand. So in this particular example, the actuary did his calculation, and our premium for our A fund, B fund was $300,000, 220 in our A fund and 80 in our B fund. Okay, that's our calculation. And we had a typical year. We had a APD claim, $50,000. So $50,000 is below 100,000. So we go take that out of our A fund. We had 220 in there. We had 50. We got 170 left. We didn't have a claim that approached our B fund, so we got $80,000 out of our B fund that we still get back. So this particular client on $500,000, because his fixed cost was 200,000 in this example. And so this client has got $250,000 of his money to come back to him, potential equity to come back as a dividend. Now, Mark, you'll notice I put up there before risk sharing, and I'll say this here because the next example is going to get into it. The B fund is where you would share with Lydia or I, okay? And there's
the A fund is on me. The B fund is part of the co-op or the risk pool.
Yes, and you can share with Lydia, but you only share in this example, in this captive example. There's other examples of captives. We won't get that deep right now, but you only share one up to the 80,000, and you only share after Lydia and I run out of our B fund. Okay.
Okay.
All right. So you never be more than your 80, and you never share until Lydia and I run out of ours. Okay. So next slide, Lydia. All right, here we go. So here's an example. So had a catastrophic year, okay, and you had a $500,000 claim, and then you had your $50,000 APD claim again, okay. So a lot of moving parts here, so stay with me. So at the very bottom, the 50 and the 500 are our 2 claims, okay. Well, the 50 obviously comes out of our A fund. That's easy. And then on the 500, begin at your A fund. So we're going to only take out $100,000. So we take out our 100, and then we go up to the B fund. Well, you've got 80 in there, but we need 200,000 to get to. Remember, at 300,000 is where we buy reinsurance. That's where we buy reinsurance from the reinsurance company, from the the AIG, the National Interstate, the Zurich, the whomever we buy from. That's where we buy. Once we get there, they take it from 300 to 2 million. Okay. All right. So we got to get there. So we need 200,000. Well, we only have 80. So that leaves us $120,000 short. So where does that money come from? Well, Mark, if this is you, it's not fair for Lydia and I to share with you because you still got money in your A fund. You're not out of money. Okay. So we're going to go back down and get the 70 on the A fund. Okay. So that gets your money. Okay. And then after you're out, then Lydia and I are going to share that $50,000. Okay. With you. You follow me? So, and again, I'm happy to go back to this. Lydia, you might want to remember this page number if someone has questions later, but there's a lot of moving parts. Okay. But again, we got to get it up to 300 to go into reinsurance, take it above that. We got 100 out of the $500,000 claim. We went up, got 80 out of our B fund. We needed 200 more. Okay. We still had money left in our A fund. So we got to go down and get that before the other members start sharing. Okay. And then here we go. All right.
Sure.
But here's the thing to notice about that. Back one page. You ran out of your funds and you didn't have to come up with any more. You follow that, Mark?
I do, but Lydia's got to spit up a little bit of money.
Yes, both of us. There you go. All right, but that's what we got in here for. Now the next page, Lydia.
Sure.
All right, now this is one of those years, Mark, you couldn't quit running into people. You just kept running into people, and you had $280,000 in claims less than $100,000. Okay, so that's the key, less than $100,000. All right, so we only had 220 projected, so you had 280. So you got a $60,000 deficit there. Where's that come from? Well, Lydia and I didn't agree to share with you in the A fund, okay? And so you hadn't gotten our B funds, so you can be assessed one more A fund. You could be assessed the whole 220, but all you need is 60. Okay? So the captive's going to spread that assessment for you over the next 3 years. 50% the second year, 30% the third year, and 20% the fourth year. Okay. Now, if this was traditional insurance and you had $208,000 losses, you're either getting non-renewed or you're getting a big increase, and you got to come up with it all at renewal time. Okay. So this is one of the advantages to the captive. It protects you against the big loss, but it also protects you against the small majority of small losses. Okay. All right. And so that you could be assessed an additional A fund. And I have had clients that have been assessed one A fund, but when we got to that and that was explained to them, one, they were happy that it was spread over 3 years, but two, they were just happy they didn't get non-renewed. Okay. And they were happy they had insurance, because had we been out in the traditional market and they had those losses, we were going to be in a bind. And I should say this right here. I've been doing this in captives since the early 2000s, maybe the late 90s, but at least the early 2000s. I've never had a client get non-renewed for this situation. If I've had a client asked to leave the captive, and I've never had that. I've seen it with other agents, but I've never had that. But if I have had one, it's because they wouldn't make adjustments to their safety program, or they wouldn't make adjustments to their hiring situation, and they wouldn't participate because the other members are at risk. Okay. And the other members, are depending on them. You're in business with other people. So you have your trucker hat, which is for your own insurance. And then you have your member captive hat, as you are a member. So you have to be you have to be cognizant of the other members. So you got assessed here, and you got to get that assessed at 60 over 3 years. But let's go back up and look at one thing. Look at the top there on the page. You did have an A fund assessment of 60,000, but you didn't have a B fund claim. Okay, so you got $80,000 again before risk sharing, assuming you didn't have to share with Lydia and I, Mark. You have $80,000 coming back. Okay, and so let's flip Lydia to that. Next page, please.
Thank you. We're trying here.
Oh, no, you're good. So I want to cover a couple things, and just these are big bullet points, and then I'll do one. So the assessment potential, again, is paid quarterly or semi-annually, depending on the captive. It's paid over 3 years, and so it's 50, 30, 20. Now, one of the other things that's really, I think, fair about the assessment, no fixed cost in there, okay, and no commissions in there. So you're not paying your agent anything more, and you're not paying the captive anything more for fixed costs. That's truly the cost of the claim. Do you follow me? Okay. I talked about the second thing is the $36,000 share of cost. Okay. And then to make sure that Mark is going to pay his assessment, because he's not going to run out on Lydia and I after the first year, because we didn't agree to share with him in the A fund. All right. There is collateral, and that can be put up in the form of letter of credit or cash. And that has to be put up for 3 years. Not 3 years at one time. It's 2/3 of your A fund. So if your A fund was 220, this is the reason we use easy round numbers. Your collateral would be 180. Okay. And that could either be in a letter of credit or cash. Okay. Obviously, the cash will draw interest and earn interest, and we'll talk about that here in just a second. The letter of credit is just cost you the cost of the letter of credit. And so typically it's 1.5, 1.25. I've seen as much as 2%. So let's say $180,000 letter of credit. Okay, 1.5% be $1,800, $900, $2,700 would be your cost of your, if it's 1.5% for your letter of credit for that year. Okay, but everyone has to put that up, not just the people that are assessed. Everyone has to put that up, and that's to make sure that we don't run out on our assessments. Okay. All right. Who decides what companies can join the captive and how they would be vetted? Well, David, that was a great question. Typically, if you're I didn't want to get in the weeds, but I'll do this real quick. This is a real high weed. So there's heterogeneous captives, which could be multiple industries. It could be, I've seen fuel haulers and movers and electricians all in the same captive. That's a heterogeneous captive. And then there's homogeneous captives. Homogeneous obviously being all trucking. Okay. So that's the first criteria right there. You want to be in a heterogeneous or homogeneous. Most of the guys, truckers, want to be with truckers. They don't like being in other industries. And a lot of times the heterogeneous electricians or air conditioner repair guys don't like to be in with truckers because of the auto exposure. So they typically, that's the first deal. Second deal would be based off your losses. And that vetting is done between your agent and the captive manager right up front. And we do most of that in my office. And so if you've got 5 years, I had one client that had a $6 million loss in 1 year, but his other 4 years were great. Okay. And so we call that a shock loss. And that member has now been in a captive with me for 6 years. So, so really two, what we call risk sharing years, out of 5 is where they really kind of draw the line. So if Mark had cost Lydia and I, and we were trying to get Mark in, and he had cost Lydia and I risk sharing in 2 out of his 5 years, he's probably not going to be a candidate. Now, as you well know, I just showed you where that's a rolling chart. So Mark's luck may change, and one of those years may drop off. And so when I'm looking at clients, if I've vetted them and talked about them and they're truly worried about their safety and they're truly involved in their claim, but they just had 2 bad years out of 5, I call them getting them captive ready. And so I'll start talking to them. I'll start working with Mark. And so when that year drops off, then we can resubmit Mark to the captive and get him in the captive at that point in time. But again, the vetting process is I want to hear about your safety. I want to hear about how committed you are. I want to hear about your, your commitment to claims. That's the kind of things I want to hear about. And I have to, as an agent, for example, one trucking captive, I've got 28 members in out of 120. Well, my 28 members don't want me to bring another bad member in. Okay. So my vetting is pretty much my conscience, because I've got to answer to those guys as well as the other members of the captive. So there's several vetting there that goes on. I would tell you, and again, not promoting myself, but you should make sure your agent knows something about captives. There are some tricks to the trade, and there are some things that he needs to know to be able to explain that to you. That was a great question, David. Thank you.
So when they do the vetting, they're going to go well beyond basic FMCSA requirements.
Absolutely. Your CAB score, I forgot to mention, David, your CAB score is very, very important in a trucking captive. If you've got, 2 alerts, they're going an explanation. If you got 3 alerts, it's pretty much no. Okay. So one of the first things we do is we run a CAB report. We get your loss runs. Those are the first 2 things that we get. And your financials are last, but that's again goes to an independent financial analyst, not us, not the captive, and he vets them just really to make sure they've got liquidity and they can pay their premiums and pay any assessments they may have. Yes, but it's well beyond just send me your loss run, send me your policy. So yes, sir.
Cameras, online training, all that.
Sir?
Cameras, online training.
Yeah, in fact,
technology.
Most of the captives have mandated at least forward-facing cameras. Okay, and of course, we have a big discount with some camera services. 2 or 3 of the reinsurance carriers have, National Interstate, for example, Great West have arranged discount services as well. That for the camera services, and then 1% of your premium is set aside for safety, to help you be safe and to help you hire consultants, okay, to help you, or you can use that 1% of your premium to buy cameras, okay? Obviously, you won't buy them all in 1 year, but you can, utilize your safety dollars. So that's set aside for members to spend on safety. And we have several members that spend it with y'all on the Infinity. And so, yes, so being safe is, obviously your other members want you to be it. You want to be it because you've got an incentive to be it now. Think about all these years in the past. Everybody promoted safety and told you to be safe, but you didn't know if you ever got anything for it. Okay. You didn't see that discount that they promised you or that premium savings. Well, now you actually can see it, based off of your loss pick. Fair? All right. One other thing I wanted to point out, I talked about getting your premiums back or getting your dividends back. I want to tell you that starts at the end of the 3rd year, because as we know, auto liability claims and workers' comp claims don't settle right away. So you every one of you will have, if you go into a captive, you will have a captive account, a member equity account. Okay. And you will get a member equity statement quarterly or semi-annually, and you will be able to see what's in your member equity statements, how much money is there. Okay. And that money comes back to you at the end of the 3rd year. That money for the first year comes back at the end of the 3rd, the second comes back at the end of the 4th, and it's a rolling situation. And so so you will be working on those claims and be involved. In my practice, we do quarterly claims reviews. So what's happening with your claims. How many of you have ever been in a fender bender at a red light and you thought, man, I didn't do any damage, okay? but then you turned it into your insurance company, and the next thing you know, they're writing a check for $50,000. Okay. Well, I can't tell you that doesn't happen with us, but I can tell you we have a method called Quick Strike, and through the captives, they allow us to send out custard adjusters or one of my claims people, and we have the ability to settle that claim. If we can put somebody in a rent car, give them the cost of the damage and put them in a rent car, and that's $5,000 or $10,000 versus, $50,000. We have the ability to do that. And so only through the claims, traditional insurance doesn't allow us to do that. And again, I'm not knocking traditional because I have both. I sell both. And so, because everybody's not a captive client, but we have the ability to do that through the captive. And so those quarterly claims reviews, how many of you have had a workers' comp incident that you just felt like the guy was just dragging on? It's first part of deer season. It's the first part of the bass spawn, and you can't seem to get them back to work. Well, you can, in those quarterly claims reviews, you can ask for that person to be put on surveillance or private eye put on them. And so, or we can ask for a nurse case manager to go to the next doctor's appointment with them. And so you have the ability to affect your claims. Okay. My wife just slipped me a note. My manager, that is, Lydia, just slipped me a note and said 10 minutes. So one more page, I think. I've got one more page. Do I haven't? Yeah. No, this is for y'all. Okay. And you can put that in at the end if you'd like, but does anyone have any questions?
David has another one here in chat.
Are there regular assessments to ensure the members are staying in line financially struggle accounts? Those every renewal, your financials are reviewed by an independent third party. I like the fact that it's an independent third party. It's not the captive manager. It's not me. And so, yes, I just had a client get put on the financial watch list, which simply means he's got to clean up his financials. You get put on a watch list, either risk or financial. You have a year to clean up your stuff or explain it. And in the event, I've never had anybody not clean up their financials or not go through the risk safety requirements that are ready. This is our Captive Ready program. Love for anybody that's in need of looking at something or has any other questions. I'm happy to answer them and to do whatever. Again, happy to answer more questions, but thank you guys at Infinity for your time today and let me be part of this.
One more observation or comment on the traditional versus the captive.
Yes.
The complaints that I hear and experienced myself personally were inflated reserves.
Yes.
And the inability to actively participate in the claim. Examples of that would be, a small fender bender. They throw a $40,000 reserve, and then you get sued, and now they throw a $700,000 reserve at it. Do you have a little more input or control over that reserve in a captive?
Yes, you do. And so I went out, I've hired 10 X claims adjusters. That's what I hired. And back, I got to be honest, when I was by myself, prior to 5 years ago, I couldn't afford to hire 10 claims adjusters, and I couldn't afford to have 70 claim safety people, but Higginbotham has allowed me to do that. And it's putting my money where my mouth is, because we spend a lot of money on that team. But that team meets quarterly, and that adjuster from the insurance company, from the reinsurance carrier, and my team are on the phone, and there will be an open debate about the cost of a reserve, or my team is the front end of who you call. So before you even involve adjuster, if there's ability to solve that claim and to put them in a rent car or to, go get their car fixed, we do that. So we have the ability to do that. So that's one of the biggest things that the captive gives you, is the ability to be involved in claims.
So the other second part, the second complaint is, of course, the participation. I hear this
Yes.
all the time. My insurance company hired an attorney.
Yep.
They were scared to go to trial. They were scared to defend it. We
Yep.
ended up settling it under a
Yep.
ridiculous amount. As a member of the captive, you would
Yep.
have at least input on how
I'm
a
not.
claim is settled.
Yeah, I'm not gonna make a blanket statement, but I'll say this: 9 out of 10 of the captives allow us to pick our own attorneys. Now, obviously, that attorney's got to be vetted, like the members are. One, they've got to accept the rates that the insurance company's paying. That's the biggest deal. But two, they have to know something about trucking. We don't want to hire a divorce attorney, to be our trucking company defense counsel. So they got to know something about that. But we, as Higginbotham, handled over 1,250 liability claims last year and 700 workers' comp. Been doing this now for 20 plus years. We've developed a laundry list in 20 states of attorneys, defense counsel that are vetted and that are good at defending trucking companies. So they're pretty much, they stick out. But yes, you can have selection in your counsel, and you do have ongoing. Every quarter you're going to be in that call with us talking about that litigation. Your attorney is going to be on the phone. Okay. Your adjuster from the insurance company is going to be on the phone with us. And all we do is represent you. We don't represent them. We represent the member. And so that, hey, Lydia, I saw a question come up, but I didn't read it fast enough. I apologize.
Charlie commented, it took us 5 years of trying to get into a captive, but it's definitely worth it. Been in for 7 years and we were very active in our claims process. And even with a few assessments, we're still consistently seeing returns.
Absolutely. And if you got assessments, Charlie, I agree with you. If you got assessments, that was because of your sins. We call our A fund your sins. Okay. And that was because of your sins. And so, you know what it is. I mean, it's the fairest way to buy your insurance.
Yeah.
So if you're not in a captive, you need to try to get into one, but you can't just raise your hand get into one. And Lydia,
Gotta
I
work with
know Infinity and online training is a huge
it.
part of controlling, managing those risks that we all take out there.
That's absolutely correct. I have a saying that says anybody can put you in a captive. We make it work, and we make it work with partners like you guys that help us on the safety side to prevent losses. It's work. It's not just your guy down the street. Every time I present one to a new prospect, as we have to get loss runs from his old agent, the old agent says, "Oh, well, I can do that." Well, my first question is, why haven't they? That's number one. Okay. And number two, how many captives do you have? And so that should be two questions that you should ask your agents if they say, "Oh, I can do captives." Well, how many do you have? And why hadn't we looked at this before? That ought to be two big questions.
Good, good. Mike, thank you so much. Everyone, if you have any further questions, we had Mike's information on the screen. We'll share a replay of this so you can, watch it back again, and his contact information if you want to reach out and ask other questions. I do have just a quick poll I'm launching that you can, answer if you want more information. One of the things that we do, we worked with one of our client success stories is a client went from non-renewable to pretty bad accidents into a captive within about a 5-6 year span. And that was doing things with us, a proactive preventative safety plan and proactive pre-assigned training to kind of automatically go, but then tons of stuff within the company and looking at the safety culture within the company. So if you'd like to take a look at that with us, we'd be glad to look at it. We also have a free event every month, boot camp, which is hosted by Steve Kessler and Mr. Mark Ray here. And boot camp is a proactive look at risk mitigation strategies, the latest trends, and then, of course, safety best practices, training best practices. We bring in trucking defense attorneys and insurance partners to talk about real tactical things that you can do to your company, to make an incremental change starting now. So that event happens twice a month. And then, of course, any of you who are NATME directors of safety, this is a webinar can be used for recertification points. So we can send you a webinar. So with all that business taken care of, Mike, again, thank you so much. Mark, thank you as always. And if y'all are available tomorrow, hop on in because we are again talking with Brandon Weissman about the upcoming pilot program. And so lots to learn there too. Thank you, everyone.
Thank you.